Hey everybody, it's Chris with Life 180. I'm super excited for today's video because I have a lot of people who are asking me what is the best way to pay for your mortgage. The reality is there's a bunch of different ways, a bunch of different philosophies, people on different sides of the camp, the Dave Ramseys of the world that believe you should pay cash for your home, the Robert Kiyosaki's of the world that believe if you pay cash for your home, you're an idiot. And so ultimately, I'm not gonna sit here and tell you what I believe is right or wrong. I think there's not necessarily a right answer. It depends on the economic environment we're living in and what the variables and parameters are when it comes to the economics behind the decision. And so the purpose of this video is to really walk you down a path to get you educated to make the best decision financially so you can set yourself up for the most financially efficient decision when it comes to buying your home, because your home is probably gonna be the most expensive asset that you ever purchase. At least for most people, that is the case. Your primary home winds up being where more of your money passes through than any other asset or any other place in your life that that you will ever have. Before we get started in all this, I want to ask you some questions. And there's some simple true or false questions. And then at the end of the questions, I want you to just kind of pause and think about them and really think, what do I think about this? What is my core belief about this question? So, true or false? Question number one. I believe that a large down payment will save me money on my mortgage. True or false? I believe that a 15-year mortgage will save me money versus a 30-year mortgage. True or false? Making extra principal payments saves me money. So here's the reality. There are a lot of options when it comes to financing your home. You know, you can get a 30-year mortgage, a 15-year mortgage, a 5-year ARM, adjustable rate mortgages all over the place. You can do balloon payments. There's ultimately, the sky's the limit as far as creativity when it comes to financing your loans. Knowing which one is best for you can sometimes be confusing, and I understand that. Before we get into any of that, I think it's really important to understand an overriding principle behind the beliefs of money and just understanding about the movement of money. And that is that you finance every single thing in your life. And that's a really key point that I really want you to sit with. You finance every single thing in your life. Now, what do I mean by that? Well, of course, we all think of financing when we say, okay, we have a mortgage, we want to buy a house, we go get a mortgage. And so classic finance says, well, of course, I'm going to the bank. They're giving me a loan. I'm going to pay them interest on that loan. So I'm going to have an interest expense that's a financing charge to buy my mortgage, to buy my house, to get my mortgage, to have my house, right? That is how most people think of financing. But I'm actually going to tell you that even if you pay cash, you're financing it. Because what's happening is you're self-financing that house. Because let's say you buy a $400,000 house. You go out, you buy a $400,000 house. What happens is, yes, you pay for that house and now you don't have a mortgage payment. You avoid the interest that you would pay the bank, but you lose the opportunity for that money to be earning you anything, right? So that money is tied up inside of your house, right? That's a big thing. And I'm gonna circle back around to that later in the conversation because it's a big point that you need to understand. But so the concept is you're either paying the bank financing charges or you're self-financing, and the opportunity cost that comes with that is you pay cash for it, but you lose the opportunity for your cash to earn money in an account, in any sort of investment or savings account, period. Because here's the deal, principally speaking, with your home. Your home is gonna go up or down in value whether you have it 100% financed or whether you have it 100% paid off. That doesn't impact the amount of appreciation that your house has in value, right? So by you putting your money in the house, there's no real rate of return on that money being put there. So that's a key principle to understand. So if that's the case, the question is this: why have a mortgage? Well, first of all, I think most people have a mortgage because they need a mortgage. They don't have the cash for it. Ultimately, there are two other reasons that I find that are beneficial to have a mortgage. And the first one is tax benefits. If you are in a 25% tax bracket, you get to write off your mortgage interest expense, right? So if you're 4% mortgage rate, you can write off 25% of that. Ultimately, on your taxes, it's gonna make your net cost to borrow about 3%, right? So Then the third reason that I think people need a mortgage, on top of needing it and the tax benefits, is the potential spread, the differential that you can have between what you're earning versus what you're paying. So by getting a mortgage, it makes it so the money, that $400,000 I mentioned, instead of paying cash for that, you get a mortgage for $400,000, and you could have that $400,000 earning 5 or 6 or 7 or 8%, right? And you could be paying a net cost of 3%. That's a huge benefit. The next thing that I want to talk about is inflation and the impact that inflation has on your mortgage and your price, the cost of your mortgage. Now, think about this. I talk about this a lot in a lot of my other videos. Is inflation is simply a hidden tax by the government that is designed to strip you of your wealth. There's no way around that. If you look at the math behind it all, the average rate of inflation over the history since 1920 or 1913, 1914, you're looking at about a 3.5% inflation rate. Well, let's just assume 3%. If you think about the principles of inflation, back in the 80s, we all know $50,000 income got you a lot further than $50,000 gets you today in the year 2021, right? It just did. That's inflation. It makes everything get more expensive. Cars are more expensive. Houses go up in cost. The cost of food and groceries and all sorts of things, plane tickets and gas and all these things, everything gets more expensive. That is the nature of inflation. But here's the beautiful part. When you get a mortgage and you get a 30-year mortgage rate locked in, you actually benefit from inflation, because while the rest of the world gets more expensive around you, what happens? Your income also goes up. But you lock in your mortgage rate. So think about that. That's a super powerful thing. Let's talk about the numbers behind that. So here's the crazy part. If you get a $2,000 mortgage today, obviously that $2,000 is $2,000 today. But did you know that in 10 years, your $2,000 mortgage, while you're still gonna have to write a check or have it auto deposited or whatever for the $2,000 balance, that $2,000 10 years from now is only gonna feel like $1,488 in today's money. That is extremely powerful. That is getting inflation to work for you, because once again, you're gonna be making more money, hopefully, just by the nature. Even if you don't get a raise, you're gonna make more money as a cost of living adjustment. And if you go out 20 years, now you're looking at, it's about $1,107 is the actual what it will feel like in today's money. So basically the purchasing power of the cost of your mortgage gets cut almost in half, if you think about that. That is extremely powerful. And by the time, if you did a 30-year mortgage, by the time you got to the end of the mortgage, your mortgage is actually down to $823 in today's purchasing power dollars. What you're doing is you're getting a discount on your mortgage every single year. Think about it this way. If you rent, what happens is the cost of living goes up every year. It gets baked into the lease. You have to pay a 3% increase on your rental agreement every single year. It goes up. In this, you're basically getting a 3% discount every single year, and that discount compounds itself, right? So it's super powerful when you understand that and you apply it. That's just one selling point for a 30-year mortgage versus a 15-year mortgage or even paying cash. So the next thing to understand is that when you finance a home, yes, you pay interest charges, but it's important to understand that you also pay principal. You also have to put a down payment on your home. And people are asking a lot, what is the optimized down payment? Well, once again, there's no straight answer. You just have to run the numbers based on your risk tolerances and what's right for you, right? And so it's important to understand, though, that when you pay that money, just like paying cash for a home, you lose the opportunity for that money to work for you. So before you make that decision, you have to figure out, what are the PMI charges going to be? What are all the other elements that come into the decision of making that down payment? What should my down payment be? So here's the deal with opportunity costs. Let's stick with the $400,000 house for the conversation. If you had to put 20% down because you want to avoid PMI, because PMI can get kind of pricey, so you have to run the numbers and figure out what would PMI cost you to really run what does it make sense. And PMI typically is a sliding scale to their exposure. So if you put, like an FHA loan with 3.5% down, your PMI is going to be higher. If you put 10% down, it's going to reduce a little bit. If you're 15% down, it'll reduce a little bit, all the way up to 20%, and you can have it automatically removed once you have 20% equity. So in an improving real estate market, when housing prices are going up, sometimes just the appreciation in the home alone, without too much work on your own end, will end up working the PMI off for you without having to do anything, which is fantastic. But it's important to understand that for a $400,000 house, if you put $80,000 down on that house, which is 20%, think about it this way. That $80,000, once again, you lose the opportunity for what that $80,000 could earn you. If you put that $80,000 into an account earning 8% after 20 years, not even the full 30 years, but just 20 years of it, you're looking at $314,000, just over $314,000 of opportunity cost loss. So what does that mean? That means if your house doesn't appreciate by at least $314,000, then you're getting penalized for the down payment. That's your break-even point as far as looking at your house as an investment of what it should get you for a return to be able to kind of be comparable to utilizing another strategy in today's environment. Now, remember I said before that your house is not a good place to store your money, because your house is going to go up in value or down in value regardless of whether you have it fully paid off or fully financed. The amount of equity you have in your home has no bearing on the appreciation that your home has. That's very market driven, economic driven, environment driven, so on and so forth. Sometimes the geography is taken into account depending on where you are in the country, but it never has anything to do with the equity that you have in your house. So the question is your house a good place to save your money? I use numbers from my parents, which is what it is. This is an example that it kind of works because the numbers are, they bought their house in 1990. We're sitting here in 2021, so I want to use a 30-year time horizon. So I was talking to them about their house and what it looked like. I think they're a pretty classic example. They bought a ranch house. I was 10 years old. I remember moving into it. It was my grandparents' house before them. They bought the house for $190,000. So they buy this house for $190,000. As a ranch house, they had these dreams over time to fix it up and do all this stuff to it. They've had to put a lot of work into it over the 30 years. They have insurance payments that they have to pay. So after all is said and done, they paid $190,000 for this house. Today's market value is $750,000. So most people would look at that and be like, holy cow, that is fantastic. Like, it's amazing that they made that much money in their house because now they're sitting on a ton of equity, right? And so what a great investment. Well, not so fast, my friend, because when you really look at the numbers and break it down, and I'm being really conservative here, and I spoke with my parents and I said, hey, how much money do you think you've put into your house? Like, actually reinvested into the upkeep, into building it up and turning it into the log cabin that it is today and doing all these different things. They said about $250,000, maybe even $300,000. So I said, okay, let's take that back and let's go $250. Let's just call it $250 even. How much do you think you've paid in homeowners insurance over 30 years? I don't know, about $700 a year where we are. I said, okay, let's just call it around $10,000, which is like $400 a year, $380 a year, something of that nature. So we'll cut that in half and be really conservative. So I'm saying they've spent over the 30 years about $260,000 in upkeep, maintenance, upgrades, all those different things on their house. And when you look at that $190,000 house going to $750,000 in value after investing $260,000 into the upkeep, because if you look at it as an investment, it's like no different than any other investment like a mutual fund. You got to look at the cost of that investment before you can look at the net returns of it. Yes, it looks great that you have all this equity, but it doesn't make it efficient. That's the thing. It doesn't make it efficient. And when you look at the numbers at the end of the day, they only have a 1.72% annualized rate of return in their house. So when you look at what I was kind of talking to you about before, this is kind of a no-brainer. When you look at it, you're like, whoa. When you understand that, you start to realize this is not the best place to keep my money. All right, so now I'm going to take this to the next level for you to understand. Think about it this way. If you buy your house and you have the option to buy it for 400 grand, what is that 400 grand? If you were to say, okay, I'm not going to pay cash for my house, I'm gonna mortgage my house, I'm gonna take that lump sum of $400,000 and I'm gonna put it into an account that will earn me money. Let's just assume you're gonna earn 8% hypothetically, because that's what everybody says you can get for returns, and I'm not gonna have arguments around all that, but we can have other conversations about the numbers that make sense, but I'll tell you what, this principle works as long as there's a difference in if what we call arbitrage, as long as there's a spread between the mortgage rate and the return rate. If you can get a guaranteed return higher than what you're paying, this works every single time. It's important to understand that. But if you took your $400,000 and invested it at 8% over a 30-year period, that'd be worth $4,374,000. $4.374 million. I don't know about you, but I don't think that $400,000 house is going to be worth $4.374 million in 30 years. But what that's saying is, if you paid cash for your house, if that house is not worth that, you've made a financial mistake. That's just it. That's just the efficiency behind it all. Now, it's also saying that if you took the mortgage and you got a 4% mortgage, your mortgage on that house is $1,910 at 4% over a 30-year mortgage. That's saying your principal and interest that you're gonna pay on that house is $687,478. So the difference between those, I got the number here, I had to do some math to figure it out, is $3,686,814. That's insane, guys. Like, you're talking about the difference if you have cash now to buy a house in cash versus financing it and having that money continually work for you. The difference is over $3.5 million. I don't know about you, but that's not a financial mistake I'm wanting to make. So if you follow the logic that maybe you had coming into this video and you listen to Dave Ramsey and Susie Ormans of the world and so on and so forth, the number one thinking of logic is that you get a 15-year mortgage over a 30-year mortgage because of the fact that you think you're gonna save money on the house, right? Because the mindset is that the shorter the loan duration, the less interest you're gonna pay, that's gonna save your money. And if you follow that logic, ultimately paying cash for the house makes more sense if possible, right? That's the ultimate end-all goal if you follow like Dave Ramsey's 7 baby steps, right? Like that's what he tries to get you to do. And when you understand the logic that I just showed you, you can see that mathematically, it just simply doesn't make any sense. All right, so here's another fun way to look at the numbers. When you look at a 15-year mortgage, the people who believe that you should go the 15-year number route, this is my favorite Dave Ramsey slide of all time, is saying, hey, listen, I'm just gonna pay my 15-year mortgage, I'm gonna pay my house off, and then I'm gonna take my mortgage payment, and then I'll be able to save. Once I have my house paid off, I'll be able to then jam all that money into investment accounts and go from there. So here's the thing. Once again, it's financially inefficient. If you take the same variables into account, let's just keep an 8% assumption for investing, and we go from there and we say it's a $400,000 house, a 30-year mortgage is just under $3,000 at $2,958, and a 30-year mortgage is just under $2,000 at $1,910. So here's what happens. The mindset is saying, okay, if I pay off my mortgage after 15 years, then I take that $2,958 and I just invest it the next 15 years, I'll be better off. Well, the reality is you're not, because what happens is that $2,958 invested at 8% over the next 15 years only gets you a sum of $1.023 million. Now, if you were to take the spread, let's say instead of going with a 15-year mortgage, you went with a 30-year mortgage. Now you have the spread, the extra cash flow between the 15 and the 30-year mortgage, the $2,958 minus the $1,910, you have that difference of $1,049 every single month that you can invest. And if you invest $1,049 a month for 30 years, instead of $1.023 million, you end up with $1.563 million. So $500,000 more in your retirement or savings vehicle, whatever account you wanted to put it in. Once again, this is all just using the same variables. This is just showing financial efficiency. It makes no sense at all in today's economic environment to be paying off your house. Once again, that philosophy was created in the 80s when mortgage rates were in the upper teens. It doesn't make sense anymore. All right, so here's the thing. Not all mortgages are created equally, right? Because a 30-year mortgage, you're going to pay a little more for the mortgage than you will for a 15-year mortgage. There's typically about a 0.5% premium you're going to pay, higher interest to get a 30-year mortgage because it's a longer duration of period of time. So the banks want to make a little bit more money, and that's okay. But look at it this way. If you take a $400,000 house, let's just assume you put the 20% down, the 80 grand, so you have a $320,000 mortgage that you just needed to do to avoid PMI. So now let's say 30-year mortgage, you have a 4% loan, a 15-year mortgage, you have a 3.5% loan. When you break that down, you end up with just over a $1,500 payment on the 30-year mortgage and just over a $2,200 payment on a 15-year mortgage. I'm not saying we don't want to have the house paid off, but I'm saying, when is that house paid off? When the mortgage balance is zero, or when you have enough money in an account where you could stroke a check and just write it off and just pay it off if you ever needed to or wanted to, right? If it made financial efficiency sense to pay it off, then you could. That's what I'm talking about. So think about it this way. When you look at the numbers behind this, but with those numbers all being said, if you were to take the spread and just do a 30-year mortgage and take the spread of the 15-year mortgage and the 30-year mortgage and invest that number, it's just over $700, I think, in the numbers that we're using here, and you were to invest that over a 15-year period, in year 15, you would have enough money in a side account if you only average 3.84% net after tax. That's it, 3.84% net after tax, 15 years into this, to be able to have enough money in a side account to pay off your mortgage. I don't know about you, but if I can't earn 3.84% in anything, I don't want to do it in the first place. That's a pretty solid bet to be able to do. So once again, I'm not saying don't pay off your house. I'm saying do the 30-year mortgage, keep control of your money, because when you put your money into your house, you cannot get it back out without getting permission. By putting the money in the side account, in a side investment account, if you decide at year 15 you want to stroke a check and you want to pay the house off and you want to be done, if it makes financial efficiency sense at that point in time, you do that. But until that point in time, you don't do it. And the craziest part of all is that if we just assume that you got 6%, right, which is pretty easy to do, that you'll have enough money in your side account, your side fund, if you were to do this strategy, that at year 13 and 11 months, you'd have enough money to pay off your house. So by doing it this way and not going about the traditional 15-year mortgage versus 30-year mortgage conversation and buying all the garbage that, you know, the Dave Ramseys of the world are preaching, you are going to have enough money to pay off your house actually faster. Financial efficiency is a beautiful thing. All right, so I think one of my favorite things to talk about as well, and what I'm excited to bring to the table now, is the conversation around the tax savings of having a 30-year mortgage. So I've already talked about the financial efficiency in every capacity up to this point in time, and I think you get that. But now, when you really take into account the fact that having a 30-year mortgage on its own versus a 15-year mortgage, because of the arbitrage, because of your ability to earn the spread between the two, is amazing. When you tap on the fact that you get tax benefits that are far superior with a 30-year mortgage compared to a 15-year mortgage, it's kind of a no-brainer. So look at it this way. In year 15, when it comes to the point where your 15-year mortgage comes to an end, if you had had a 30-year mortgage, you're gonna have just over $40,000 in tax write-offs. That same mortgage, with your 15-year mortgage, you will only have had about $22,000 in tax write-offs. Now during that 15-year period, that's $18,000 in extra tax write-offs. The beautiful part about that is the fact that, listen, everything else is already more financially efficient. Even if you got no extra tax write-offs at all, you're still way ahead in today's economic environment with all the variables in today's world, right? Yet, look at this. It's even better. You get more tax advantages. If you slide up here, I've got a little tool here. At 30 years, you actually get $57,000, almost $58,000 in tax write-offs. So you actually almost triple your tax write-off ability with a 30-year mortgage. Plus, you have infinitely more financial efficiency and strategy and flexibility. And there's so much more that goes with this, but it's so much more powerful. So that is just understanding how inflation comes into play when it comes to your mortgage, how arbitrage comes into play, the spread, being able to earn the difference between what your investment accounts or savings accounts could make versus what you're paying for a mortgage after taxes, taking into consideration the tax benefits of the mortgages and the different variables that come into play, and understanding that you finance everything in life, period. Whether you finance it through a bank or you self-finance it, the self-financing, the opportunity cost of losing the ability to have that money work for you and earn for you is extremely powerful. So let's go back to our quiz. The first question I asked is, what is your belief about a large down payment saving you money? Do you believe a large down payment will save you money on your mortgage? Most people, I think, say yes, but I think we now realize the answer is no. What was your true or false belief statement about, did a 15-year mortgage save you money over a 30-year mortgage? I think most people said yes, but now you see the answer is no. A lot of people believe that making extra principal payments will save you money by saving you interest expense. But I think I just showed, instead of doing that, you put it into a side fund. If you earn 3.84% after taxes, you're gonna pay off much, much faster. So once again, the answer is no. And of course, a lot of people believe that having your house paid off makes you more secure than having it financed 100%. But I would argue the actual opposite is true, because if you have your house paid off, I would say it's more liable to legal disputes. You can be sued, it can be taken away from you. There's a lot of negatives that come with that. Plus, your house value is not going to go up or down in value regardless. So you're losing economic power, economic leverage to be able to create wealth for your family by having it tied up in the equity in your house. So I hope you found value in this. I hope that, if you are looking to get a mortgage, if you have a mortgage right now and you're contemplating what should you do, maybe you have a lot of equity, you're debating what to do with it in this really booming market right now for real estate. You're thinking about doing a cash out refi, you're thinking about all these different things. The one thing I'll say is be very, very careful about what you do with cash out refis. I will also say this, when it comes to your mortgage and when it comes to all the philosophies that I just said, the one thing I'll say is the reason Dave Ramsey says what he says is about wanting to have everything paid off is because he doesn't believe in your ability to be disciplined, right? But the reality is being disciplined is absolutely required to get to the point where you can pay cash for these things and utilize his strategies. What I would say about how to pay this off, and when you see the strategies and just the numbers and the efficiency behind the numbers that I shared with you today, this is mathematical fact. There's no arguing it. Like I literally could have a conversation with any single person in the world about this, and it's not debatable. It's a mathematical fact. He might say that for emotional reasons you want to go his direction, but the bottom line is, if you're disciplined enough to do that, you're disciplined enough to take the spread and manage a budget and do the things the way that I'm showing you on this documentation as well. So if you want to talk to somebody, you can, down in the description below. I'm not a licensed financial professional anymore. I just really believe this is something that everybody should do. I've got some contacts that you can get a hold of. You can set up a call with somebody. If you just want to have a conversation about this with me, I'll even give you about 15 minutes. We can have a brief conversation. And if it makes sense, I can connect you with somebody in my network that might be able to help you. But I'm really, really passionate about this topic. I think it's one of the most misunderstood topics in the world of personal finance. And so I'm really excited to be able to share this with you. I've been thinking about doing this video for a long, long time. Really excited to get this information out there. If you have any questions at all, please comment in the description below, in the comment section below. I try to do my best to engage with every single comment possible. If you found value in this, I would really, really appreciate a like. It really helps out the channel. Make sure you hit that subscribe button, click that bell, that way you get notified every single time I launch a new video. I look forward to being able to see you around on the channel, engaging with you in the comments, and I hope you have a blessed, inspirational day. I look forward to talking to you soon. Take care.